Today on the Wealth Transfer Podcast, we're digging into the crossroads of planning and legacy, especially for business owners, with Luke Britt. Luke advises ultra high net worth families and business owners on two fronts: planning companies for transition years before they might need to sell, like getting it ready well before you actually plan to sell, and executing advanced integrated estate planning, so how those things work together. He also has a great conversation with me about family values and helping families to make an estate plan around what they want to transfer besides just the material wealth. We'll unpack how to de-risk a business before an exit, what an ESOP might look like and how that can be a great option for some businesses. And we'll talk about why not waiting is the number one rule of estate planning. I think you're going to enjoy learning a little bit of tax strategy, some strategy for getting your business ready to sell, and you're just going to enjoy hearing from an expert like Luke Britt. So let's jump in. Welcome to the show, Luke. I am so glad you've joined us. And obviously you specialize in helping high net worth individuals, ultra high net worth individuals plan for whether it's business transfer into the next generation or to sell their business or to just do estate planning around all of their wealth. And so tell us a little bit more about your specific business, what you do for the wealthy and why it might make sense for you to be here on this Wealth Transfer Podcast.
Sure. Thanks for having me too, man. I really appreciate the opportunity to kind of tell my story here and have a conversation with you. So there's two sides of the business. Like you mentioned, there's business advisory. And in that business, we're primarily working with business owners who are looking to transition their business at some point. Some of our clients are in their 30s and 40s, so that time is maybe a really long time from now. And others who are maybe on the precipice of an exit. And so our advisory team helps them prepare the business, really understand what their business is worth, and then identify the perfect exit path for them to follow. So that might be putting things in place to protect their business value from eroding, from losing key employees, key contracts, things like that, all the way to how do we exit the business in a tax efficient manner and retain the most that we want. Alongside that practice, and really kind of in conjunction with that practice, is what we call advanced planning. And so for advanced planning, that's typically really high-end estate planning. I'm a tax nerd, dork, whatever you want to call me. I'll take all the names that you want to throw at me. I like to get in the weeds, get technical, and make those technical applications really simple for our clients to understand so that they can build the legacy that they want to build and really live out that vision that they have for themselves, their family, and future generations.
So you mentioned that you're the tax nerd, but also you've published articles and other things on that as well. What does the process look like to also keep the focus on legacy and maybe the other nuts and bolts of wealth transfer, not just on tax planning? I think oftentimes we only see it from a tax planning strategy. How do I make sure the government gets as little of this as possible? But you seem to care more about the legacy and the other pieces. Tell me more about that.
Really, I think I would correct something there that you said, is that I really care about both of those things with equal weight. I think that the problem that from the professional services or advisory community is we're so focused on the math problems that we lose really the whole intention of preserving our wealth and passing it on to future generations. So I come from a pastoral background, and that's really helped me learn how to communicate with people, feel what people are feeling, and really help advise them in a way that's more like a counselor than a financial advisor in that sense. But I know the technical way to solve problems.
I feel very similarly. And I think oftentimes we see situations where there's a significant amount of wealth transferred, but the family wasn't prepared for the transfer, right? The kids or the heirs weren't prepared. And so the most beautiful situations are when the family's spending that energy to say, who do we need to be and how do we need to show up for our kids and our grandkids or whoever the heirs are in a way that they're prepared for the weight of this wealth and that they're going to use it in a way that's actually causing human flourishing and not just causing their demise, right?
Yeah, totally. Yeah. So I'm actually in the process of writing an article, hoping to get published in the next few months, about the myth that exists that you spoil your kids when they inherit money. Because every one of my clients is worried about that, and they're worried about passing on a large amount of wealth, and then their kids don't have an incentive to work. And a lot of that is easily mitigated by just, like you said, let's talk about our family, like what we believe in, what our values are, what we want it to look like moving forward. And when you do that, there is really very little risk that you're going to spoil the next generation by setting that path in motion.
Well, and I think the reason that people have that fear is because there is some legitimacy to it in some cases. And probably the ugly cases shine the brightest, right? People see the bad situations, and those are the things, and we tend to talk about the negative, or we tend to, gossip about the bad stories. And the quiet, private, unassuming stories don't necessarily get published quite as much as the scandal. And so
Absolutely.
So I think but there are, and especially if you work in this industry, you see both cases where you're like, wow, look at how beautiful look at the relationship between the kids and their parents. Look at how they already make decisions together. Look at how they're already thinking about, what the legacy they want to have, or what they want to invest in, or how they want to make an impact, or how they care about other people, or even what the family values are, just the conversation around that. It's really beautiful. So I agree that it doesn't have to spoil the kids if you invest in building family values. Now, on the business advisory side, obviously you're working with people that maybe aren't ready to transfer their wealth, but they're just thinking about what does it look like to have a shift in owning a business to maybe not owning a business, or selling part of it, or transitioning out of that, or maybe buying another one. And then obviously there's people doing exit planning. What does the process look like for somebody who's saying, I'm ready to take some steps out of my business? How do you guys work through advising them?
Yeah, so it's a process for sure. But the first thing that we have to do before we can do anything is to gather data. And a lot of time, that is the heaviest lift on the business owner's part. But it's also something that they value tremendously, because it's something that has been on the to-do list for a long time. It's like, let's kind of get everything organized so that if something happens to me, my spouse or my coworkers, my key people, they're not just left in the dark. They know where everything is. And that's really how we start, is let's get all of our data together and we'll put it in one place. So what we do is we build out what's called a personal financial website for our clients. And so they have this thing they can look at on their smartphone or on laptop, whatever, that will show them what their net worth is, what the value of their business might be, and also show cash flows. They can use it for personal budgeting if they want. Most of our clients don't. But for the most part, that is there for them to be able to run reports, look at things, and they have a vault where they can store all their documents. So that's where we get started. But then from there, it's really identifying what are their at-risk position, because I like to think of the business as really your most concentrated asset in your portfolio. And instead of just thinking it as my lifestyle and my identity, it's really an asset in your portfolio that you need to manage and mitigate the risks. So we look at at-risk positions, make sure we de-risk. And what that does is it makes you a lot more valuable to an outsider, because they know that you've got kind of your ducks in a row, you've got everything set up, including things like, are my employees paid properly? What's keeping them around if I were to sell the business? How do I kind of lock them in, make them feel like they're valued and they're going to benefit from any kind of future changes, things like that, to key contracts, to all sorts of things that can be a risk in a particular business. So from there, we look at, well, what are our options? There's so many options on how you can transition a business. Sometimes our clients come to us with a very specific idea in mind. Got this person that I want to sell it to, but they can't afford it. How do I do that? Or, I don't care who buys it. I just want to get out in 5 years, whatever those options are, or I want to sell to all my employees through like an ESOP plan. There's so many different ways to do it. But so we really dive into values, which we've talked a lot about already, and what is most valuable to you from a legacy perspective. And then we walk into that with, here's the exit path that you should go down, and really maintain that plan until we're ready to pull the trigger on an exit.
You mentioned ESOP, and I'm familiar with that, but maybe our listeners aren't. Tell us more about that idea of like different options to sell a business and what an ESOP is.
So an ESOP is a qualified retirement plan that can hold corporate stock for employees. So really, let's take away all that jargon I just said. And what it is it's a trust that holds the stock of the company for the benefit of all of your employees who are eligible to participate. So when you think of like, I want to sell to my employees, you kind of have to decide, does that mean like a couple people? Like, I've got this lady over here who's been with me forever. She can run this thing in her sleep. I want to sell it to her, or I want to benefit her somehow with some stock. That's a different conversation. This is for someone who says, I don't want, typically their attitude is, I don't want some outside firm who doesn't know me, doesn't know my values, doesn't know the culture of the business I've built, to come in and kind of ruin everything. I want to be able to sell to my employees so that they can continue the vision that I've created and maintain the culture that they've all built together. That's who's an ideal candidate for an ESOP. And that's what an ESOP does. I mean, then there's so many statistics that ownership, because it gives really every employee a piece of the company. They have something in the company, they have ownership. So their productivity typically increases. And you have people who are in jobs that don't normally have big retirement plans or something like that, ending up with 7-figure retirement balances when they're ready to retire. It's pretty cool option, but it has to be for the right person. If you're looking for, I want all the cash in my pocket today, then an ESOP's not going to be it. But if you're willing to wait a little bit to get all of the cash on the transaction, it can be an ideal option if you really, really value legacy over getting top dollar cash upfront.
A few years ago, I got to tour Taylor Guitars in San Diego, and Bob Taylor had owned his company since I think the 70s or 80s and had built it. And it gotten to the point where they were pretty large. They had a number of employees. They were handcrafting guitars. And so when he was speaking to us, it was a private tour, it was a small group. And he was telling us, we recently sold our company via ESOP. And it was the first time I'd seen it up close and personal. And I thought, what a cool, certainly, he was talking about the loans that they had taken back on their ownership so that they could because they're getting paid out. They're still selling the company. It's just you're selling it with loans. Like you said, it's maybe it's deferral of cash, but I've got to imagine that deferral of cash might also be a tax strategy, right? Versus taking all the payment at once. But the legacy, what was so cool was that all the people that now have even more connection to the company, and also they feel like, this person didn't just sell them out. They actually took care of them on the way out. So now I've heard though that it's not an quote unquote expensive strategy, but it requires a lot more advice. It requires a lot more professional management of the process than maybe just a simple sale. And so what size company do you recommend before someone considers something like an ESOP?
Yeah, so a business really needs to have at least $1 million or $2 million in EBITDA or more. So it's just net income when you add back certain things on your profit and loss statement. But I usually say 2 million or more is an ideal situation. And it can't be just like 10 employees. You have to have a lot of employees, and so that you can spread out the stock, because there's some rules and technicalities over having concentrated owners in the stock. So it's really those kind, but I think more than that, because there's lots of people who meet that criteria. More than that, it's all about why do you want to do it? So an example, we had a client in New Mexico who just went through an ESOP transaction recently. And for them, it was, I've been through the private equity ownership. It wasn't for me. I've got a lot of people here that we're trying to make partner, and they had some challenges with maybe some partners who'd retired, and how do we make those note payments over time? And how do we still have enough cash to bring on new people and keep them around? And so their vision was, we want to promote partners. We want to increase the lifestyle of our employees. We want to be able to recruit people to come join this company. And we want to be here for hundreds of years, and people can work for this company for as long as possible, and everybody gets a piece of the deal. That's ideal, right? I mean, for them, it was, how do we maintain this culture? How do we benefit our employees? And that is exactly the right candidate.
That's awesome. Now, switching gears for a second, you use a phrase in a lot of your writing and in your bio called integrated estate planning. And you sort of already talked about this. I think you probably already given us a little bit of an answer, but what do you mean when you say that? What does that mean to you?
So I have this chart that I wish we could pop up here, but what it shows like the stick figure right in the middle. So there's a stick figure in the middle, and that's me as an individual or a family. And I've got all these thought bubbles around me, and these thought bubbles are all of my advisors. So I've got like a financial advisor that might work at a bank or a separate bank. I've got an attorney, I've got an accountant. I might have like 3 attorneys, depending on what my business is. And I have maybe some outside consultants. And a lot of times we go to them one-on-one, and they give us advice, and then there's conflict in the advice. Or even better, in some cases, I go do something with one of my advisors, and none of the other advisors know. And so nobody knows if that's like the right thing for me to do, or if it's going to really impact something else that another advisor is doing for me. And so what integrated estate planning does is it brings all the advisors to the table to make sure that we're thinking through clearly all of the financial issues, all the tax issues, all the legal issues, all sorts of different things like that. So integrated advice across multiple disciplines is what really kind of defines an integrated estate plan.
And what are some of the biggest red flags or issues you see people have in either selecting advisors or having their advisors? Like, what are some of the issues you see that people have in selecting those advisors?
I think the biggest red flag is when they lean on one advisor who doesn't have a team. And so what I mean by that is there's a lot of financial planners or other disciplines. I'll pick on that since that's kind of my background is wealth advisory. A lot of financial planners out there who have a shingle, but they don't have the resources that people need for really complex situations, ultra high net worth and so forth. And so being able to maybe lean on that person is okay, but they've got to be able to tap into all other advisors who know the stuff that they don't, instead of having one advisor trying to be kind of the lead dog and be the expert in all things. So you really want expertise that's deep in a lot of different areas and not just in one person who claims that they can do everything.
Do you have any, or can you think of any horror stories or even just negative experiences where you're like, gosh, this is where people made the wrong mistake or made the wrong decision?
Yeah. So one of my best clients came to us and they said, hey, here's the first time I met this person. I bought this thing from this advisor and I have no idea how it works. And what it was a really complicated insurance strategy for estate plan. But it was, hey, I'm asking questions and I don't know like what the answers are to these questions, and nobody can answer them for me on that advisor's team. And the advisor had brought in an attorney. They kind of been like the one-man show, like I was talking about previously. And so we ended up reviewing that, and it was just, there were so many things that didn't link up with what was told versus what really existed in reality. And so that ended up unfortunately, in some litigation. Took a while to get clear of that, but now the client's in a much better position. We've built a great team around them and their family, and making sure that we're all communicating together at least twice a year on the plan and what's working, what's not working. And that's such a huge improvement from where we were. But there, for her, it was going to really lead to a disaster if we didn't intervene and really explain what they had, the benefits of it, maybe the disadvantages of it, and what the outcome could be if there was a change.
Yeah, I see that a lot as well. And or even hearing from other professionals, and I'm not sure what the specific product is, but so often, especially when the client doesn't know what it is, if they're not told exactly what to do, like they forget to execute the plan. And so then all the benefits go to the wayside, and maybe even the negatives start showing up because it's like, well, you didn't execute on this. So now you're dealing with a tax consequence or loss of principal or, some other issue where you're like, if we had known the plan and we knew what steps we had to take, this would have been so valuable. But because we didn't, now we've missed all these windows, we missed timelines, and we're dealing with, consequences that make it worse than if we'd never bought the thing to begin with.
Yeah, 100%.
Makes total sense. When you have clients, and this is kind of a one-off question, but when you have clients with portfolios and you're looking at their allocation, I think a lot of times investment advisors or wealth advisors, they're thinking about stocks or other type. But in situations where someone has a private business or they own a lot of real estate holdings, like we deal with, and a lot of ultra net worth people do own businesses and also own real estate. So what are you seeing as the mix? How much a percentage of their portfolio would you say is either in owning their personal business or owning real estate or owning other assets that are maybe more passive?
Yeah, so my clientele is maybe a little different typically. So I have some clients who say, I will never invest in the stock market at all, period. Like I just don't trust it for whatever reason, even though it may be trustworthy and has a long history of providing returns. I'm just not interested in it because I can't control it. I'm hoping that someone else does a good job instead of me doing a good job. So those clients typically really dive into real estate, private investments, maybe even like private credit, where they like do some hard money loans, things like that. That's stuff that we don't manage, obviously, because we can't as an IAR, our investment advisor. And so for most of our clients, they're going to be heavy, at least my clients, I should say, they're going to be heavy in real estate, heavy in private equity, private capital. But a lot of them still have like a little mix of that. And then we do have some clients who, they say, I don't want to deal with anything. I don't want to manage any real estate. I don't want to do any of this stuff. So just put me in some stocks, bonds, and maybe a little bit of alternatives. So it's kind of all over the map to answer your question. But a lot of my clients specifically, because I work with a lot of clients who don't care about liquidity. they don't want to have cash on hand all the time, and they like hard assets. A lot of my clients are probably 90% in illiquid assets and 10% in liquidity.
Yeah, totally. Are you seeing a lot of clients moving out of asset classes that I sometimes call them noisy, like things that require a lot of management, or asset classes that maybe aren't performing as well, into like things that are more passive or better cash flow? Are you seeing people stick with the thing they've always had?
Yeah, that's a great question. So this kind of goes back to the team environment. So I personally don't manage anyone's portfolio. So I'm leaning on other experts in my firm to do that. And most of the time what I'm seeing is there's always a sliver of the boring. There's a sliver of, okay, we're going to be in domestic equity. We're going to be in all the names that we've been talking about forever, but we're also going to maybe slide in some of those, the private capital, private credit, that's definitely becoming more and more in vogue because of the cash flow it can generate. Even though it's illiquid, it can generate lots of cash flow. And people, I think, are very interested in cash flow. But for the most part, I think there's a lot of people who maybe owned a business who were like, I want to get into real estate. Like I've owned my commercial building that was with my business forever, but how do I expand that? I want to grow that. And how do I do that in a way that's safe and that I can control, right? And other people are like, what are the other investment opportunities I have? Like we had someone approach us who said, I want to build a back office so that I can create a family office. So what I mean by that is I want an investment platform. So what that looked like for him is I want to set up an LLC that is based not a venture capital fund, but more like just private investor. And so I want to be able to say, okay, I'm looking at this deal. Can someone review it and tell me what the risks are? And so we have a firm in our firm, since we're a big accounting firm too, we brought in our transaction advisory services team. They do like quality of earnings. They do all this kind of valuation work, all that kind of stuff. So they could be the back office for that portion. And then it's like, well, how does that fit in with the rest of my portfolio, with the rest of my estate planning? Should I put this in a trust? Should I put it in a different entity? That's where my team can step in and help with that. And then the rest of our team can say, here's what the other portfolio looks like. Here's how the risk dynamics balance, things like that. So for those types of clients who are like, I want to invest back in entrepreneurs, I want to help people grow their business, I want to look for good opportunities. That's really attractive for a lot of business owners post-exit.
Yeah, it's interesting you bring up private credit, or I'm seeing that a lot as well. A lot of people wanting to move extra cash flows into placing hard money loans, or because they do have a great return. And in most cases, if you've done your underwriting well, or if you've got the right system, you're avoiding noise or problems or frustrations. You're just kind of rotating that money. And we are also seeing a lot of people that are wanting to move out of things that maybe were underperforming so that they can get better cash flows. Like and it is sometimes owning more real estate, or owning real estate that's maybe a little bit easier to manage. Like it's either professionally managed, or it's something that they don't have to be in day out, but they still get the cash flows from. But we'll do analysis all the time, and we'll see, well, yeah, you've owned maybe these pieces of real estate, you've owned this portfolio, but it's not really cash flow. It's not really providing, I guess, a little bit of cash flow, but relative to the value that's appreciated to, you're getting very little cash flows. Rents have not kept up with the actual building values. And then we'll help them do some 1031 exchanges, or we'll talk through a strategy of like, do we want to place this money do you want to pay the tax and then place it with your advisor? Can you make up that tax quickly in certain asset classes, like you said, private credit or other things? Yeah. Anyway, it's interesting, but we are seeing a lot of people that I often say want to move away from the noise, right? They're like, how do I get a similar return with less noise? Or how do I take something that has been more of a problem and make it where it's got a little bit more long-term stability? But
yeah, I think to that point, like we have our annual conference where we have like our team, our employees and advisors come to our conference. And a few years ago, we had Kevin O'Leary speak, Mr. Wonderful from Shark Tank. And he said something that stuck with me. And this is probably 3 or 4 years ago. And he said that most wealthy families, when they have exited their business or whatever it is, they're at that point where they're not in the grind anymore. That it's more interesting to preserve what you have than it is to chase a return. And I think that's so true, because in his words, you already won the game. You don't need to lose. So go win the game. Invest in things that are not noisy, that have a consistent return, simple. I think that's pretty attractive for someone who is really, they've really taken a lot of risk as an entrepreneur and grown something great.
Going back to, business succession planning, when somebody's thinking about in the next few years, I need to figure out how to get my business set up to sell, or whatever my different options are to sell. And oftentimes You were talking about data collection and you're getting contracts and employee information, but also the financials. One of the mistakes I see often, especially in smaller, or we should say medium-sized businesses, because they're not really small, but even in medium-sized businesses, is that their data is not really organized in a way that's going to optimize their multiple when they sell. Aside from collecting the data and getting that, what are the first steps that you recommend, or how do you talk to a business owner that's got a really valuable business, but maybe they need to do some work before they get ready to do succession planning or exit planning?
Yeah, it's a great question. So one of the first things we do is we have a sister company within our network that is a mergers and acquisitions broker dealer. So they represent businesses who want to sell their business, take it to market. And so with what they provide for our clients is they provide an assessment of what the market would think their business is worth. In order to do that, we've got to collect a lot of financials, typically 5 years of financials, tax returns, and so on. So when we do that, we can see like how clean is this data. And sometimes when we come back with the assessment, the results are, we don't really know because of the data that we got from you. So I think you need to meet so-and-so, and they can help you clean up the data. And a lot of times, if that's maybe we're thinking about a transaction in the next few years, that might be like a quality of earnings type report, which our firm does, or it might just be that we need somebody to provide reviewed financials from time to time, make sure we're clean. Maybe we can take on some of the bookkeeping for you to make this easier. But those are the kind of things we walk through from the quality of the financials perspective. There's so many other things that they may not have prepared that we need to step in and help, and things that sometimes they don't think about.
What are some of those warnings that you would give people who are thinking about exit planning or transition planning?
Don't wait. So we did an event in Atlanta earlier this year, that was for exit planning and estate planning focused, and only business owners were invited. And so the business owners that came got to hear from some of our clients who have had successful exits. And that was really powerful. And every one of them said, don't wait. I wish I would have done it sooner. And it's not that there's so much work that has to be done. It's just that you want to be prepared so that in the event, there's a perfect time for you to exit. And you can never time it, but let's just say it's the perfect time, that you don't have to hope it happens this year or hope it happens next year. The timing of the exit can actually be pretty irrelevant once you have all your ducks in a row so that you can be ready to exit whenever the appropriate time comes. So that's what any successful person who's exited their business and they're happy with it, which by the way is only about 5% of business owners who exit, say you need to start sooner, get an advisory team around you to help you really build a plan for what you should do from now until you exit. Yeah, don't wait.
You mentioned getting good advisors and then also several different either reports or analysis. What are the various advisors you need in this process as well? And some of them may even be all within your firm, but what are the names of the advisors? And then what are the various analysis or reports that you tell business owners to get in these situations?
Yeah, so I'll start with the advisory team because that's easier to explain. So you're already going to have advisors, right? You're already going to have a team of advisors. Really, it's just who's going to coordinate all of those advisors. So that's the principal job of the exit planner, in my opinion. Exit planner can run point with all the advisors, bring everybody together, keep everybody on task, and assign tasks for each step in the process. So that would be an exit planner, financial advisor, business attorney, estate planning attorney, their accountants, maybe a bookkeeper. We do a lot of work with construction firms, so sometimes that's their surety people or their property and casualty insurance. There's all sorts of people who need to be at the table, maybe not all at once, but definitely at different phases during engagement. But the very first thing that we want to look at is, can you really afford to transition your business today? And what that means is, I've said this for probably 15 years now, that financial planning is summed up in one simple sentence, which is, how do I get enough cash to buy stuff, pay for stuff? That's it. And so what we're looking at is, how do I turn this into liquidity? And then how do I deploy that liquidity in a way to meet my lifestyle goals and what I want to provide for my family? So that's where we start first, is what's the magic number that you need every single month that is going to help you live the lifestyle you want? And then how do we deploy the excess liquidity to make sure that we're providing legacy, we're providing for future expenses? So it's really a financial planning exercise first. Then diving into, okay, what about our employees? How do we keep them around, get them excited, like I said before? So we run reports for that. We do tax analysis with our CPA firm. And so there's so many different things like that we can run, but we need everybody on the bus that needs to be on the bus to be able to really provide accurate information and good recommendations. And that, again, that's the role of the exit planner with all these other advisors on the team as well.
Now, Luke, you have written a number of articles, or you would like to put out content. Where do you have any pending articles or interesting thoughts that you have that you're kind of chewing on right now that we can get a preview of what you're thinking about?
Yeah, so I hope to write a lot more. Got a lot of things I would love to write. But one thing that keeps coming up over and over again, and it has for everybody for all time probably, is when I asked clients about their family, and maybe they've got a really large estate, tens of millions of dollars, and they're worried about spoiling their kids or grandkids, depending on how old they are. And they're worried about there being this $10 million, $20 million windfall falling in their kid's lap, and then it just ruins them. And because there's statistics that wealth typically doesn't last longer than 3 generations. And so for me, I think that the spoiling the kids issue is an easy one to address. In fact, I think it's so easy to address that spoiling kids could be a myth. And so it's really the way that I address that is, let's look at that not just for generation 2, which is the next, your kids. Let's look at how we can preserve wealth across 3, 4, 5 generations. Like, think about what your wealth could do over the next 100 years. If you really plan carefully and think about how you could carry your family's values, your mission, your family mission. I love family mission statements. How could you take this wealth and perpetuate that for really as long as you want? And that's where it gets into a different conversation. Okay, now I'm not worried about spoiling my kids. Now what I'm focused on is how do I preserve this, not just for my kids, but for my kids' kids, and so on. So I think that's what I'm working on right now. That's my next piece of content. And I think that's so compelling to people who have this amount of wealth and feel the weight of that responsibility of planning for it so that their kids aren't coming into big windfalls and spending it on dumb stuff. But yeah, that's what I'm working on.
Well, and I think too, okay, so you've sold your business, or you finished in what your work identity was. And sometimes you feel that lack of identity once you sell a business. You're like, well, who am I? What am I doing anymore? And then to think about yourself as a strategist around your family's legacy, specifically on who do I need to show up as for my kids and my grandkids in a way that they absorb my values, that they know our story, that they know who we are, that they then take on those things. And sometimes it feels a little late if you start thinking about that after you're just not selling your business, but it's never too late to at least transfer some of that information. It's never too late to start telling those stories in a way that maybe the grandkids or even the great grandkids can hear that and take on those values. And I often tell people, when you shift away from the prime of your work life, which might have been owning your business, and you move into that doesn't mean you stop working. It just means you stop working for money. You stop working for the business value, and now you work on. And many times people start caring about contribution or legacy. And I think one of the most valuable things you could do is say, what kind of conversations do I want to have with my family so that this legacy or the things that I care about don't die with me?
Yeah. So, that's such a huge point. So I like to paint it, because a lot of times we build out the estate structure, like what trusts are we going to have, what entities are we going to set up. We pattern that after what you're talking about. So one of the things that I like to do initially is we want to create a family business, and I call it that. It's family business. Now there's technical names for what that means, but let's just build a family business, and we're going to put the assets that need to be in the family business. So that can be stock portfolio, could be real estate properties, could be the boat or plane that every business owner wants to buy after they have a liquidity event. It could be whatever it is. We're going to dump that into this family business, and then we're going to have people who run that business, and that's generation 1. So that's the business owner and their spouse together. Typically, we're running the business. We control everything that happens in the business, but we want to benefit the other people who are on the bus, right? And so if you're thinking of that from a business owner perspective, is you have your kids that are going to be a part of the team. They're on the bus with you. But then you need other people on the team too. So you need to hire people to help you typically run the business, just like you would in your operating business. So that could be your CPA, your estate planner, financial advisor, whoever needs to be on the team. And they're a part of, typically we're getting into conversations like family office at that point. You have like a trust company. So somebody needs to be a trustee, somebody needs to administer the trust. And so when you're looking at it like that, okay, I was the CEO, founder of my company. Now I'm focused on being the CEO and founder of my family, and a great transition.
Yeah, that's awesome. All right. Well, Luke, how can people find you? Like if they've got either a referral to give you, or if maybe they've got a business and they're thinking about needing some business advisory, or maybe they're a family looking for some estate planning, where can they find you and your firm?
Yeah, so you can always go to our website, which is Level 4 Group. That's level and then FOUR group.com. I think the best way is just to reach out to me directly. Happy to have conversations, happy to be a fly on the wall in a meeting, or whatever you want, whatever role people want me to play. Also available on LinkedIn. That's another place where people can catch me and find maybe some of the content that I put out as well. But yeah, just a phone call, email away.
Well, thank you for being on. That's it for today's episode of the Wealth Transfer Podcast. If you found value in this conversation, would you leave us a review? That would be just so honoring to us. We'd appreciate it. And if you know somebody who might need to listen to this because they're thinking about their next chapter, will you send them a link to this podcast or this video so that they can listen more as well? For more episodes and expert insights, be sure to follow and subscribe. That means the most to us. Follow and subscribe, please, please, please. And when you're ready to take action on your own real estate plan, or if you need help with wealth transfer planning, we know a number of experts in all the different spaces. We'd love to connect you with them. You can reach out to us via direct message or comment. You can email us, matt@templeton.realestate. No .com, just templeton.realestate. And I'd be happy to connect you with an advisor. Thanks so much.